Hey, what's going on everyone? Welcome back to another video. In today's video, we're going to talk about structure and how you can master structure with this really small 10 to 15 minute video. So without further ado, let's get right into this topic. So number one, what is structure? Structure is a very important part of smart money and trading in general. Matter of fact, you can't trade smart money if you don't understand structure. So structure is essentially like the ABCs of forex, right? Now, structure, to summarize it, it's basically the way the market flows. And there's only two ways the market can go. It's either it can go in an uptrend or it can go in a downtrend. Now, there's obviously the consolidation and the stagnant and the manipulations, but we're going to keep this video short and simple, and we'll keep all those other topics for future videos, inshallah. So structure, as I said before, it's the way that the market is flowing and how we read the charts, right? If I delete everything right now, all we see is candlesticks going up and down, up and down, up and down. But with a little bit of structure, I can now see that this is a low instead of a random down candle. This is a high, this is a higher low, and this is a higher high. So this is the basics and terminologies of understanding structure. It basically gives you information to look at the charts and construct the setup and understand where the market is going, whether it's going up, whether it's going down. Now, a good practice I usually used to do back when I was learning a lot was I'd go to the charts and I'd create a theoretical example. So I'd do something like this. So we create a bunch of random structure, and I would give myself two tasks. I have to mark up the macro structure and I have to mark up the micro structure. So the macro structure, the macro is essentially what's happening on a larger time frame perspective. So instead of looking at all this small stuff going on over here, you're more looked at the long term, the big moves in the market. So for example, this high to this low was one big impulsive move. And then from this low to this high was another big impulsive move. And then from this high to this low, we have another impulsive move. And then from this low to this high, we have another impulsive move. And then vice versa, vice versa. And that right there is the microstructure. The definition of macro, not micro, forgive me. The definition of macro is the outside view, right? If you search up the Google definition, it'll tell you something about like the outside and etc. whatever. Now on Forex, it's similar. We're more looking out at the zoomed out perspective. So a perfect example of this would be if I zoom in right now, you could see all these little, you could see all this. You can see the inside structure. But if I were to zoom out, now you can't really see the inside structure, but you can still see overall where the market is going. It's heading down, right? So this is macro. It's a zoomed out perspective. Now micro is when you're zooming in to find the zoomed in perspective, and you're basically looking at every little bit of critical information. So by critical information, I mean you have more structure. So for example, you have a low, or you have a high and then a low, and then a lower high, a lower low, a lower high, a lower low, a lower high, and then a lower low. And then from this point, you have a high, a higher, a low, a high, a higher low, higher high, higher low, higher high, higher low, higher high, and then the market reverses once again, and it creates a low, a lower high, a lower low, a lower high, a lower low, a higher high, a higher low, a higher high, and then a lower low. So that's the microstructure perspective of structure, and the macro perspective is basically ignoring all the mini information that resides within the impulsive moves, and all you're looking at is where the impulsive move starts and where it finishes. And that's essentially what structure is. Now, you might ask the question, now that we understand microstructure and macrostructure, when do I use macro and when do I use micro? So you want to use macro when you're generally trading the higher time frames, such as the 4-hour, the 8-hour, the 12-hour, and the daily. And you would want to use the microstructure when you're trading on the 1 hour, the 15, the 30, the 45, or the 5 minute. Now the thing about this is I can't give you an objective time frame to use. This is all personal opinion from backtesting and trading and trial and error. So certain pairs will give you but certain pairs will look different. So for example, let's say I'm trading Euro USD. Let me get my text tool out. So let's say I'm trading Euro USD. Make this 20. Now on Euro USD, the 1 hour might look like this. Like it's just one big move going up, and it doesn't look clean at all. You might see like one of those impulsive moves with like one candle pullbacks, and then It's really ugly and it's hard to understand what the market is doing. So in those cases, what you would want to do is you need to scale down to the smaller time frame. You must scale down to the 15 minute, the 5 minute, the 30, or whichever time frame it is, until you can find the information that's needed. Oh, I just made a mistake. Let's get that back. Oh, okay, it looks like I can't. All good. Give me a quick sec. Boom, back to 20. And all right, here we go. So yeah, so the 1 hour might look like this, but then you might notice that after you scale down to the 45, the 15, or any time frame, you'll see more information. You'll see something like this. But let's say even this is not enough to give you an idea of what the market is doing. So then you go down to the 15, and on the 15 you might see something like this. You see more structure now. And this is the beauty of microstructure. It gives you more information, so you know so you can get the information that you were not able to get from the higher time frames. Now that we understand this, boom. The second thing is you must understand supply and demand, because supply and demand is a big factor to structure. For example, when we look at the higher time frames, we've all seen those big moves ups and then those huge moves down, and then one of those big moves ups and then another big move down and another big move up. So you might wonder, what's causing these big moves up? Well, it's demand zones, right? It's the demand zones that reside within the impulsive moves. So within each impulsive move, the market will leave around 2 to 3 valid order blocks or demand zones, whichever you want to call it. And then price action comes back down to mitigate those zones, and then it goes up to replicate the same move that it made before, because the trend is bullish. Now, let's move on to microstructure now. With microstructure, I'll explain how I use microstructure by explaining this setup that I'm looking to get involved in really soon. So USD JPY, just from looking at this pair, right? Pause the video, and I want you all to take a guess of what the trend is. Anticipate what the trend is right now. Not from micro, rather from macro. So you can pause the video. Hopefully you paused it by now and you got your answer. If you said bullish, you're correct. The trend is bullish on the macro perspective. So to prove that, you can see there's a low and there's a high, and then there's a higher low, and then there's another higher high. So just by this information, we can understand that structure is bullish, and most likely the market is going to continue to go higher and higher and higher until we break past a macro low. So for example, if the market broke past this level right over here, which is a macro low, then we would consider to be in a bearish trend. But because we have yet to break past that macro low, we're still in a bullish trend. Now let's see the micro perspective. From the micro perspective, we're basically zooming in. We can see there's a low, and then there's a high, and then there's a higher low, higher high, higher low, higher high, and then the market breaks structure right over here. And then the micro structure changes. It goes from the high to a low, to a lower high, to a lower low, to a lower high, and then I can't even see that. Hold up. Okay, so it did not create a lower low. It just created a normal low. And then right over here, we switch once again. We create a low, and then a high, and then a higher low, and then a higher high, right? So now, remember I brought up that example where sometimes the market might do something like this, like it leaves a small one candle pullback and goes up, and that's not really enough information for you to act upon. So what I do in this situation, what I did was I seen this impulsive move, and we can see that microstructure is bullish. Microstructure is bullish because we broke past this level right here. Now, but within this most recent expansion, we can see microstructure is bearish because price action broke past this one candle pullback. But if I go into the 8 hour, it would literally just look like one big move. And that's not enough information to give an idea of what the microstructure is. Matter of fact, you can't even see microstructure now. All you can see is the macro. So this is where I start going down to different time frames. So I go down to the 45 and then the 20, and I'm basically just getting an understanding of what the structure looks like on different time frames. You have to open your perspective. And now I could see that there was even more structure residing right here. There's a high and then another low. So price action ends up breaking past this micro low right over here. Now, when a micro low is broken, we don't necessarily anticipate that the entire trend will be bearish now, that we're just going to fall all the way back down to the gutters. That's not really what it's like. So when you see a break of structure on micro time frames, this is when you have to transition to the higher time frames and locate where the next demand zone or supply zone resides. Now, why? Well, because if we break structure, that's essentially meaning that the market is looking to go down somewhere. where is it going to go down to? Is it going to go down to the left, the right, the bottom? No, it's going to go down to where the next demand zone is, or the supply zone. But in this case, we're looking to buy long term, and we're in a bullish trend. So we're gonna use the buy example. So in this case, we see a break of structure right over here, and that confirms that the microstructure is looking to restabilize price, to find a gas station. If you're not aware of the gas station analogy that I use, I'll quickly explain it right now. The gas station analogy is basically the order block is the gas station, and you yourself, price is like the car. The car drives to where the gas station is when it's running low, and then the gas station fuels the market with what it needs, and then boom, we just explode all the way to the upside. Now, in this case right here, we can see price is stagnant at 135.754, and it's just chilling there. It's residing there. It's not really moving up and down. It's just, it's doing its thing, which requires patience. So now that we know the micro broke structure, all we have to do is zoom out, go back to the higher time frames, and see what the higher time frame micro trend is. The higher time frame micro trend on, like, for example, the 5 hour, or let's go to the 6 hour, 7 hour, 8 hour. So the higher time frame micro trend on the 8 hour is bullish. As you can see, there's literally zero micro structure to even look at on the 8 hour time frame. So we kind of have to use the macro. So from a macro perspective, what do we see? We see that USD JPY, just to make this a bit cleaner, I'm gonna take a screenshot of this, and then all right, so USD JPY, it created a low, and then it created a high, and then it created a higher low, and once again it created another higher high. Excuse me, sorry. So what that means is that this higher low, if the trend is bullish, we have to respect this higher low, and that the market will not break past it. So price can basically trade within this low up to this high, but it cannot break past this low. The second price action breaks past this low, we're no longer bullish, right? Because it contradicts the higher high, higher low, and not analogy, theology, right? And if we're not creating higher highs, higher lows anymore, that means we're creating lower lows, lower highs. Boom, perfect. We're all on the same page. So now we can use supply and demand to understand structure and where price is going to go next. So we can see that this order block right over here that's highlighted in the purple drawing, it was the final OB that resided at the bottom of this a huge impulsive move up. Price action comes back down to mitigate that OB. So let's use a different color now. Let's use blue. Price action, where'd my mouse go? Oh, here we are. So price action comes back down to mitigate it. All right, that's probably one of my most straightest lines drawn ever. All right, so price action comes down, mitigates the OB, and now it's heading up. Now, remember on the 1 hour, or I think it was the 15-minute, we saw like a one candle pullback right over here. On the 8 hour time frame, we can't see that. But on the 1 hour, now that we know that the 1 hour did something like this, we know that price is looking to go back down so it can mitigate another OB, so it can find the next gas station, because it's not bullish enough to just go up right now. So it needs some help. It needs to find some stability. In this case, the market will head down to the next OB. So that's going to be right over here. So price action is coming down into this order block, and then from here it can go up. So notice how on the micro time frames things look bearish, but on the macro time frames we're generally bullish, and that we can be short term. We have to be short term bearish in order for us to be long term bullish. Now that's how I personally use micro structure and macro structure together to construct this setup. Now let's break this setup down, and yeah, let's break it down. So boom. What did I see? So right, like as I explained before, there was a break of structure of this 1 hour time frame, one candle pullback, right? We've seen that there was a one candle pullback right here. Price action broke past it. From there, I went to the 5-minute time frame to see what supply and demand was doing, to see what the institutions were doing with their money. So we could see at this point, this is where institutions stopped buying. Now, the reason they may have stopped buying could be due to various things. One factor may be because price was overbought. A second factor could be they were just simply not looking to buy. And then a third factor could be liquidity. But obviously, we can just anticipate. We can't know for sure. But we could use these three factors to come to a more concisive decision. So right here, where institutions stopped buying and they started to sell, we can see that the sell side orders were entering the market, and then we were presented with that break of structure. From there, price action comes back up to mitigate the last supply zone, the last up candle before the move down. As I always explain in my video, if you guys haven't watched that video, make sure you watch structure and order blocks. I have a whole playlist which I'll link on the screen right now, so make sure you watch that playlist. It'll help you understand what I'm talking about. But what just to summarize it up, usually when the market is trending one way and then there's a break of structure, price action always comes back up to the open or the beginning of where the impulsive move started. So for example, the beginning of the impulsive move started right here. The market comes back, retraces about 80 to 70%. Sometimes it might even do a 90% retracement. So it does about a 70 to 90% retracement, and then the market continues and sells off, which is the official last phase of a structural shift. So right here, what I have seen is that price broke structure, and then after we broke structure, like I said before, we came back up to the last up candle before the move down, so we can mitigate the OB. That OB got mitigated. Now in the form of this mitigation, we created another order block that broke a microstructure. So microstructure, as you can see right here, was we have a low, a high, and then a higher low, and then a higher high. Price action breaks down. It literally bleeds after we mitigate the first supply zone, and that resulted in a break of structure of microstructure. So from there, microstructure was once again bearish, and because the supply zone caused that, we can now confirm that this supply zone is strong, and it's a supply zone that the institutions have in mind. Now, once again, we have another supply zone that resides at the top, so that means microstructure will have to be bullish before it's bearish. So we have a low, we have a high, a higher low, and then a higher high. The market comes back to mitigate this supply zone, and then once again, we bleed down. We bleed down and we break a ton of microstructure. Now microstructure is once again bearish. So now notice the pattern. It's basically we create a impulsive move down, microstructure is bullish, we come back, we mitigate, and then we go down once again. And then same thing happens. There's another order block that resides right here. Microstructure is has to be bullish for a bit. And then once we reach that supply zone, the market bleeds. So in this case, that's what I'm anticipating right over here. So all right, clean, we deleted all that. So now we have a new supply zone that's at the top. Once again, it's at the top. I refined the supply zone to this 3-minute OB, and I took the high just over here to protect my position. And yeah, there you go. So that's my entry, and we can see that the confirmation is there because it provided a continuation of structure. We broke past all these lows, and we have a break of structure. So that's all the confirmations that are present, and it also is co-aligned with my trading plan. So from here, we could see that price action has been creating bullish microstructure. So we have a low, and then we have a high, and then a higher low, and a potentially a higher high. So obviously microstructure is going to have to be bullish for the meanwhile. It'll do something like this. But once we reach our entry, our supply zone, we're anticipating microstructure to switch back to bearish. But how long? Where am I going to get out, right? Because microstructure, we're not putting it above macro structure, because macro we're still bullish. From the higher time frame perspective, zoomed out, we know that the longer time frame trend, the longer term trend, we're still bullish. So where am I going to get out? Like I said before, we're going to get out at this demand zone. This demand zone is merely just a gas station. It's merely just a supporter as a friend. You could even consider it as a friend. Basically, right now, structure is like micro, it's bearish, it's sad. And then macro kicks in. Macro is like, yo, no need to be sad, bro. Here's some money, here's some, here's some bullishness, here's some momentum. And then that gives microstructure the momentum to switch from bearish back to bullish. And then we also have macro structure, which is bullish, and then we have double the power, and that causes the market to go up. Now, of course, there's still the possibility we break past this low, and if that happens, I'll simply be looking at this order block at the bottom. I'm not going to get into this one. I'm not going to get into why I'm using this order block, because that's a whole different topic, which will lead us to be here for about 20 to 30 to 45 minutes, God knows how long. But the topic is discounted and overbought and oversold. So anyways, that's the anticipation I have for USD JPY. You guys are going to see what happens even if I'm wrong. So hopefully, let's hope that I'm correct. Fingers are crossed. But anyways, that's what I have for now. So also another final thing I wanted to talk about is that when a structure is broken, right? When structure is broken, like something like this happens. where price action breaks past a previous lower high, the market has now created a range. The range starts from where the last low was created to where the last high was created. So what do I mean by the last low and last high? So we could see that everything is bearish. We're selling off. We're selling off. And then just over here at this point at 106534, institutions were no longer interested in selling. And then they moved their money from sells into buys, and that caused the market to go up. Self-explanatory. Now, once we went up, what did we create? Like visually, what can we see? Visually, we can see that there's a break of structure and that the trend itself is no longer bearish. It's bullish now. Now, what you want to do next is find where the impulsive move, find out where the bullishness started. Where's the origin of the impulsive move? The origin of the impulsive move is this low, and where it finished was this high. So we started off by creating a low and then a high. Now that doesn't necessarily mean we're definitely like in a locked bullish trend. All it means we're in the early stages, the early phase of transitioning into a bullish trend. So price action creates a low and then a high. Now we've created a range. So the market can trade from this low to this high, but it cannot break this low. The low must be protected and we won't be able to break it. But the high itself, eventually it will have to get broken. And then we create a new range. So once price breaks past this high, we now created a new range which is protected. This low, which was the last higher low, which created a higher high, is now the range the market can trade within, but it cannot break past it. Although at times you might notice price breaks past a range, at that time, at that moment, you should switch your bias right away. You would want to switch your bias and move on. But realistically, objectively, in a higher high, higher low trend when the market is going up, usually the higher lows are meant to be protected because the higher low is actually what's causing the market to go up. Without a higher low, think about a higher low like this. The higher low we can see right here, there needs to be some type of sell side pressure to create a higher low, right? Now, when the higher low is created, what that's basically telling you is that sellers are not strong enough to push price lower and lower and lower, and that buyers are stronger so that they overpowered sellers, and that institutions took their money out of sells and moved their money into buys, which stopped the market from heading down and caused the market to go up. And then we create another range. We break past this high, we create a new low and then a new high, and then the market trades within this range. So that's exactly what I have on the USD JPY setup right now. On the 1 hour time frame, you could see we're bullish. 100% we're bullish. Yeah, I have to delete all this because this is way too ugly. All right, there we go. So boom, we're 100% bullish, and we broke past the microstructure right over here. Although microstructure from the zoomed out perspective is bullish, the zoomed in perspective is bearish. But what did we do? Now that we broke structure, as I explained before, the market was going down and then we broke structure, and now price is right about over here. What that means is that the market cannot break past this low, and we've created a range. And now the market can do whatever it wants to do until this low. It cannot surpass the low. So that explains why I'm looking to sell, and it also gives me a target in mind. Now within the range, you're going to find order blocks. Now when you are how to find out which order block is better, which one is stronger, that compares to different factors such as, is the order block discounted, is the order block in a level where it's not overbought, it's not oversold, does the order block have volume, has the order block grab liquidity. There's a million different factors. Not really a million, but there's like about 5 to 10 different factors, and in reality all you need is about 2 to 3 confirmations for an order block to be an order block. And in this case we have a break of structure. In this case we have a break of structure, and if we measure this impulsive move, we could see that the order block I'm focusing on is right over here, this final move down, and this is where my target is going to be. You also may wonder and be like, yo, Traq, like how are you so confident in this OB and not this one and not this one? So this is for you. If you generally get confused with which order block to choose, my best advice to you is just practice, backtest, and eventually after backtesting and practicing choosing the right order block for like a couple of months, you'll just have a gut feeling and intuition that'll tell you which order block to take and which one not to take. Like I can't really give you the secret. The secret is out there, right? I gave you all the rules. I gave you the tools and why. I gave you the information in which would help you find out which order block is better. Now, to get like comfortable and always knowing which order block is correct, that comes with practice and patience. So take your time, backtest. You know, there's no rush. The markets were here 100 years ago. They'll be here 100 years later, hopefully. All right, don't quote me on that, but yeah, hopefully it'll be here 100 years later. So yeah, just practice, back test, and eventually you'll get a good feeling and intuition. So before I end this video, my entry was just over here on the 3 minute, right? Yes. So we're looking to enter right here. Let's go back to the 1 hour. So this is my anticipation. Now, what I'm looking to do is I'm looking to sell here. I already set a limit, and we're gonna get out at the open of this OB. I also might not close right away. I might wait to see how the market reacts, because I am anticipating a huge crash on USD JPY either this week or next week. Now, you might be wondering why I'm predicting anticipating a crash when the structure is bullish. So this is once again where intuition and experience kicks in. So I know for a fact that this order block will not be left alone. It will get mitigated. The market cannot leave this OB by itself. Why? Well, because of multiple factors. One, we have a ton of imbalance. And imbalance is a main tool that we should all use to figure out where the trend is likely to head next. So we could see that there's imbalance from this point all the way to this point, and then if we go down to the 5 minute, there's probably some imbalance like somewhere over here, but we have imbalance, and that's visually like we could all visually see that there's imbalance. You don't even have to mark it up. And then a second thing, the most recent impulsive move that has yet to been mitigated, or that has yet to been retraced yet, is this one. We could see that the market created a low, and then it pushed up and created this high. And as I said, after every single impulsive move, the market usually does a 70 to 90% retracement. In this case, we haven't even done we've done a 50% retracement. That's about it. So that's not good enough. That means that everything that's residing above the 50% is overbought. And that if you're looking to buy within the zone, and it's not for scalping purposes, you're actually looking to buy long term, that's something scary. You should be worried about that, because we're in a overbought place right now. And you could also see that the market is now moving sideways, and from the market just moving sideways, just seeing how the momentum has shifted because we're in the range of 50 and 0, that information right there is strong enough to tell you that most likely we're going to go down to go into a level of discounted so that we can buy. Institutions will not buy when things are too overbought, because they know they can buy at a better price. And right now things are way too expensive. Same things like if you and your wife decide to go to the mall and you're trying to buy some like sneakers or like some nice Jordan 1s, and it's like $400. You're not going to buy it when it's $400, because you know that's so overpriced. You're going to wait for the market to come down, settle down, restabilize, find some stability, and then boom, when it's at $100, you're buying kicks for the whole cousins, for your families, your 2-year-old cousin, all of that. So it's like, that's what you have to do. You just have to be patient, wait for the market to come back down when it's cheap, and that's when institutions will make the big move. And that's exactly what happened right here. We could see that everyone was looking to buy around here, because like we can't see what's going to happen next. And when you see 3 big 4-hour candles with a ton of momentum, we generally get induced and tested, or not. Sorry, that's horrible language. That's horrible English. We get induced to buy early. Yeah, we get induced to buy early on because of FOMO, fear of missing out. But the next thing you know, the market ends up falling. It finds another order block, and then boom. The reason this happened is because the price was overbought. Simple as that. In this case, we could see the same thing is happening. We're so high right now that the market is way too overbought to continue to buy, and that the institutions would be doing injustice to themselves. Their investment, the money they're putting in right now, would not be a smart investment because of how high the market is. So therefore, the market is going to have to go down, as I said, like 50 times, and then from there it'll go up. So that's the anticipation I have, but that doesn't mean I'm going to set my take profit here and only get out over here. No, I'm going to move off of what the market does. So my next move is going to be based off of structure. So whenever the market comes in here and we get triggered in, all I'm going to do is see how the market reacts into my first take profit level. If we react nicely, forgive me for that, I'll call them back. All right, so if we react nicely, as in like we break past it, then we will hold the trade, and I'll move my stop loss into my stop loss into profit. I'll take partials along the way and move stops to break even. But if we see something opposite, like the market structure is actually shifting and it's going up, then it's time to get out. It's time to call it a day, take your money and go away. So anyways, I hope this trade does end up hitting TP and it goes my way. If not, you guys will still get to see my transparency, because I'm generally like super honest with my trades. I've had losing weeks. I even had a losing month a while ago. The Discord people in the Discord know how transparent I am with my trade setups and all that. So maybe you guys can get an idea of what it's like to be in the Discord. And if you are interested in the Discord community and the course, it's the link in the description below. click it. If you have any questions, you can hit me up on Instagram at TraqFX, TraqFX. If there's any Instagram name that doesn't have TraqFX, like it's not TraqFX, there's like TraqQFX or TRA_FX, it's not me. The names are very similar and it can trick you, but it's not me. And I never DM you first. I will never ever DM you first. I don't do investment plans. The only service I sell is a course, and that's accompanied with a Discord community. So besides that, thank you all so much for watching. I'll catch you all in the next one. Leave a like, subscribe, comment, and salute. I'll see you all later.